So welcome to the next edition of Conversations with Qapita. And today we have yet another insightful conversation lined up for growth companies and more specifically for SaaS companies with a global focus. And it's also a timely topic, I would say. It's still, I think the funding winter doesn't seem to be going anywhere. It's still extending beyond, and we're seeing, I think, small number of companies raising large, growth stage funding, maybe as compared to the 2021 frenzy. So companies are focusing on limiting their burn, extending their runways, conserving cash, right? So hence it's very important to talk about this topic, capital efficient growth for SaaS businesses. That's what we are going to discuss about. And to decode this, we have Kaustav Das with us. Kaustav is the co-founder and CEO of Efficient Capital Labs, ECL, as we call them, and they're also a close partner to Qapita. They're part of our Qapita bundle, and they help companies raise non-dilutive capital. And he'll obviously talk more about what they do. Kaustav, welcome. And we also have Lakshman. Lakshman is the co-founder and CEO of Qapita. Again, Qapita, we help manage equity for several companies. So good evening to Lakshman and fresh morning, I think, to you, Kaustav. So hope you both are doing well.
All good. Thanks.
Thank you for having us, Srikanth. And as you said, along with the funding winter, I'm calling in from actually a cold winter morning in New York. So thank you.
Right. So hopefully this conversation will warm you up. So Kaustav, maybe we'll start with a quick round of introduction. Why don't you go first? Maybe we'll keep it to a minute, and then we'll actually have a set of points to discuss after that. So why don't you give a quick introduction?
Again, thank you for having me. I am the co-founder CEO of Efficient Capital Labs, and we're going to talk about how efficient and capital efficiency is going to be one of the primary topics. So what we focus on is cross-border SaaS companies and helping them with what we call revenue-based financing, right? Why cross-border? The reason is when we embarked upon this journey, what we realized in markets, specifically in India, while the availability of capital has become a lot better than what it was 4, 5, 6 years back, the cost of capital in the local market is still fairly high, right? Even if you talk to any alternative players that are there in the market, even if you talk about venture debt that are there available in the market, the cost of that is fairly high. But most of these software companies, they either already have a US entity, most of the revenue comes out of the US. So it almost becomes a price hack for them if you think about raising that same capital out of a country where the cost of capital is lower. And that is how this entire thing germinated. We focus on companies that are growing. We focus on software companies. It doesn't matter whether you are VC funded or not VC funded. You can be a bootstrap company. You could be 2 years into your journey, 3 years into your journey. We become a part of your capital stack. And as you mentioned, Srikanth, we are non-dilutive. Everything that you have built with your sweat and energy and love is all yours, and we would want you to keep it that way. And we are one of your cheerleaders as you grow.
Awesome. Thanks, Kaustav. Sounding too good to be true. I'm sure there are strings attached in terms of the criteria, so we'll get to that. Maybe Lakshman, why don't you introduce briefly as well?
Hi, I'm Lakshman. I'm co-founder and CEO of Qapita. Qapita is in the business of equity management and liquidity solutions. By equity management, we provide cap table and ESOP management for both startups and our private companies, and also to the listed companies. We provide end-to-end solution of designing the ESOP policy, and then also help you manage it on a platform. We also provide this, as I said, for both private side and also to the listed companies. And we also solve the second big pain point. What we solve is the liquidity in the private markets. We provide liquidity for all the stakeholders, including the employees, the shareholders and also to the founders of the private companies. Liquidity is quite a big pain point because companies take 10 to 12 years to become public or do some strategic transaction, whereas employees get their shares vested in 4 months, and the early stage investors have a 4 to 5 years horizon. We provide liquidity for both these stakeholders.
Wonderful. That's a great introduction. Thank you, both of you. So I think the topic we're going to discuss is capital efficient growth. So I think it's a very timely topic. I'm sure a lot of founders would be very interested to know more about it. But before we get into the efficiency part, maybe let's decode the various capital choices that founders have, right? Let's just place all of them and then really look at what is relevant when, right? So maybe Costa, maybe this is something that you can take, as to if you can decode all the various choices available to founders, maybe bring a SaaS lens there, and also when do these different choices become relevant from your experience? Yeah.
Sure, sure. So this is a broad topic. It can become a topic of its own. But what I will try to
Right.
do is try to keep it crisp. So usually when you think about it, there are four different ways of raising capital that or having capital for your system that you're building. The first is, as we all know, venture capital, right? In which you go ahead and you raise equity. There is dilution in which you give a part of your company to them, right? And the pros and cons is the pro of a venture capital is like it's multi-fold of your ARR. If you are a $1 million ARR, you can raise $5 million. If you're $2 million ARR, you can raise $8-10 million. It's always multi-fold, right? So it is never a fraction, right? It is multi-fold. The second thing about raising an equity is it is an attestation that this is something that can grow big. That is an attestation of what you are building. It is a ratification that what you are building is also believed by somebody else who's willing to put their capital, right? Who's willing to bet on it. So it becomes an attestation of it. The con of that right now is, first, you have to give up a part of your company. Sometimes it can be fairly significant. Where we are right now, it can range from starting from 10% to all the way to 25, 30, 35%. So there's a big part of the company that you need to give. So you need to ask that question, when is it the right time to do it, right? Or how much you want to raise. Do you actually want to raise the 5x, 6x of your ARR? Or would you rather raise something else? The second thing is, as we all know, the VC environment has become a lot more constricted, as you said, than 2021. So the period to raise that capital has become a lot more. You cannot get a term sheet in a 2 to 3 day conversation. It's a much more longer process. The due diligence that is done is long more. The declines that you get are long more. It's a long drawn process. You're talking about 3, 4, 5 months process. And the higher you grow, like a pre-seed is an easier conversation than a seed. A seed is an easier conversation than a Series A. The bigger amount or the one that you're raising elongates the conversation. So that becomes a pro and con. So the first is venture capital. The second is venture debt, right? Venture debt stands in between. It is not as dilutive as a venture capital, right? However, a venture debt not always, most of the time will piggyback on a venture capital. Very few times you'll hear that somebody has given you a venture debt when you have not raised venture capital. So they hedge the risk. All the venture debt players, they hedge the risk. You raise a venture capital, then I will give you a venture debt, right? Venture debt, again, is never a multiple of your ARR. It is always a fraction of what you have raised. It is a fraction of what your burn is. So it is never a multiple. The second thing about venture debt is it is not as cheap as raising regular capital. It can be fairly expensive. And it is, as I said, it's always in between. It is not as dilutive, but there are also hidden costs. There are warrants that are there. There are minimum draw that is there. There is a closing fees that is there. So all of these costs add up. Again, each one has their pros and cons. The pro about venture debt is it is not as dilutive as venture capital, right? It is less dilutive. The second thing is venture debt can be slightly quicker than a venture capital, because if you raise a venture capital, the due diligence is a lot lesser. The con, as I mentioned, is they give you a fraction of it. The second thing is they always piggyback on venture capital. Bootstrap companies in general are always left out, right? They never get the warm love and fuzzy feeling from a venture debt. The third thing is there are a lot of other costs that are associated. You should understand venture debt really well, not just go by the headline that, okay, I'm getting it at a 15% effective interest rate. You should understand there are a lot of other hidden costs. There are warrants, there are closing fees,
Right.
minimum draws. That's the second thing. The third is alternative capital. That is where we fit in. Alternative capital, when I say we we're not the only choice. There are other choices that are there, whether it's other revenue-based financing, other fundings like Club, Velocity, there are a lot of others that are there. Pardon
Right.
me, I'm just going to make sure that
Yeah, you want to grab a glass of water?
I'm good for now. So the third part that is there is alternative funding. So alternative funding, on the other hand, as you can imagine, does not fit in any one of these things. It is non-dilutive. That's the most important thing. We don't go for dilution. And it's not just us. Any other competitors that we have is also very similar. There's no dilution attached to it. I'm going to take that water. Apologies.
Yes, yes. Yeah, why don't you do that? Maybe I'll bring Lakshman you in, right? And you run Capita, and it's a growth stage company. You run actually raise multiple rounds of capital, and so maybe you can share your experience on this. What Costa was alluding to, and I hope he'll come back soon, and he'll complete. I think that was a great primer, I would say. But what is your experience with regard to these capital choices? Maybe Lakshman, you want to briefly touch upon, and then I'll bring back Costa in. Yeah.
Right. I think Kaustav touched upon the main source of funding, which is the venture capital, and also then the venture debt, and then alternative sources of funding, which is where the efficient capital labs and other companies come into picture. I think one instrument which is not touched and which is also now quite, which is current common in this current funding winter, and where earlier companies raised value at a much higher valuation than what they're eligible for, is the convertible instruments. Where companies are raising for the growth. As they reach the growth stage, they raise the money as convertible instruments. A convertible instrument is an instrument which generally is like a debt, but it has a feature of conversion at the time of the next round, typically at a discount of 10 to 20% based on the duration before the next fundraise. So this doesn't dilute the company immediately, and this gives the time for the companies to grow the business and reach the valuations. And also there is also both protections for both the investor and also the company, because there is a cap and a floor, whereas a cap gives a protection to the investor, so that if the valuation goes up too steep, then they're not getting very less equity for their convertible instrument. And there's a floor so that the company and the founders are protected, that it doesn't dilute lesser. But like Kaustav was saying, everything has a pros and cons. A convertible instrument, the benefits are that you get the time and to grow into that valuation, and this also happens when you are looking at any acquisition or a thing, when investors can't price your company. But the cons is that there is that uncertainty when this instrument will finally convert, what would be the typical equity percentage. And if you raise a convertible, you can't raise another convertible after that. You have to raise, because you can't raise continuously convertible instrument, because it becomes complicated. No one knows what the eventual equity will be. I think that's what I wanted to add for what Costa
Correct.
was.
Yeah, and we have seen enough cap tables where there are multiple rounds of convertibles, and the calculations go for a toss. But Costa, I think it was a great primer, and I think together you've kind of alluded all points. But I'll get back to you, Costa, on if you want to continue the point. Another point I just wanted to add was, many times we tell, right, equity is the most expensive form of capital, but a lot of early stage founders don't find that intuitive. So maybe you can also decode why do we say that, and why they should actually explore the other sources of capital as well.
Absolutely. And I'm going to just finish the conversation that happened with the alternative capital. And Lakshman, thank you for pointing out convertible debt, right? There are other forms of debt that you can also raise that are there. So the pros and cons about alternative capital that is there is, alternative capital, like a revenue-based financing, it's never a multiple, it's a fraction. So what that means is, if you're looking to raise big for $1 million ARR, you will never get a revenue-based financing that is $2 million or anything more than $1 million. You'll get a fraction of it. Whether it is, some people would give you 200,000, some people would give you 600,000, but it's always a fraction of it. So that is a con. So depending upon how much you want to raise. The pros for these type of capital is, it is very quick, right? So most of them is digital. There is not a whole lot of documents that are being asked that are there. It is absolutely non-dilutive. There's no gotchas. Okay, fine. There is a fine print out there which says that, hey, if you do not pay, suddenly we're going to take your hand and a leg for your equity. You don't have any of those things that are there. The third thing about this is, it's a very short-term duration, 12 or an 18-month. What that means is, in that period of time when you pay it back, it is no longer reflecting on your liability. You can grow, you can go to any other stage after that. So there are a lot of advantages that are there when it comes to revenue-based financing. Now, you asked a very, very important question, Srikanth, is a lot of these early stage founders, whether it is a Series A, Series B, they don't consider alternative capital. They don't consider alternative capital. And I'll give you my view. There's no right or wrong. And it's a very interesting view when it comes to Indian founders, right? Or Indian mindset that is there. For some very strange reason, there is a mindset of debt, right?
Debt.
People consider debt to be negative, equity to be positive, and it's a mindset challenge, right? If you go to other markets, whether it's US or in Europe, debt is an instrument for you to grow. In India, the first thing that people think is debt is an instrument that is negative. If I'm taking debt, it is a negative reflection of what we are. If I'm taking equity, it's a positive reflection of what we are doing. That is the battle that we fight, right? That is the education that we are embarked upon. Debt is not negative. Debt, if anything, has a lot more positives than equity. You chanced upon, you told some of those things. Equity is you're giving up something that you are building. You are giving up something that you want to give to the people that are working for you. You're giving those stuff. Debt is short term. Equity that you have is for life. You're giving it up for life. Debt, what you're giving, is for a period of time. You grow, you get out of that. Debt is something that catapults you to the next level, right? So to answer your question, this is the mindset, the mindset, the apprehension, the stigma that is there is what we are fighting against and what we are educating people on. Lakshman, I do not know whether you have faced something or whether you have any thoughts on that.
No, I think you're right in that. I think the debt carries that stigma. I think in one way is because generally in developing countries, the rate of debt, cost of debt is very expensive, right? It's now these days the cost of debt has come down and lower in countries like India. But earlier it used to be that 15%, 18%, 24% the cost of the debt. And whereas in the developed countries or where it is around the 4%, 5% and 7%, which is manageable. And once you're not able to pay that interest compounds very much, and then it crosses the principal very fast, sort of a thing. I think that stigma has continued, but now, again, I think it also depends on the business models, right? Some business models of the startups, like where there's a predictable cash flow, which is like a SaaS businesses, or where there's a working capital needs for like an e-commerce, where there's a clear visibility that okay, this cycles up in a month or month and a half, and you can repay back. Then it very much falls into the debt is comfortable. Whereas in companies which are still growing in a consumer businesses, which they're still building a business model, there's no clarity in the revenue model. Then it's not clear when are actually making the money or when you're converting to cash. Then that becomes a difficult one.
You're 100% right. Like also the same education, right? Like for example, a working capital loan is different from an installment loan. A working capital loan can be 30, 60, or 90 days. An installment loan is 12 or 18 months. The very difference that you mentioned is an education by itself. Like somebody who's looking for very short term, like for example, you're a company that was on net zero. Suddenly your enterprise customer said that I'm going to put you on net 90, right? Which means that you are still going to get the same amount of funding, but I'm going to give you after 90 days. Now that is a working capital problem. That is not an installment loan problem, right? But people need to be educated that you only have a 90-day gap. So you take a very short-term loan, but people will have conversations saying that, okay, now can I pay this back in 12 months? Can I pay this back in 18 months? Of course, it's going to be more expensive. So again, education of why you need a working capital and why you need installment loan. And a lot of people say that, oh, you know what? I'm going to use a GTM. I'm going to go into US, but I want to pay it back quickly. I want to pay it back in like 90 days max because I don't want the debt. I don't want it to reflect in my current liability. And I want to try to ask them is all of these are smart. Like, why? Right? Whatever you're investing in your GTM, you're not going to get the ROI in the next 90 days. No one is paying you back that money, right? You would want to spread it out. You would want to pay it back in 9, 12, 15 months where you get the ROI instead of trying to pay that back. Again, it is, you very aptly put it, there are different components that are there, and people, if they are educated to understand these components, they can use it a lot better for their advantage.
Right. No, this is great. I think this is a great primer. I would say all of your comments put together, and that's the intention of this conversation. So I think, and I think well answered on the part on the why equity is very expensive. And one example I also give is imagine you gave too much equity, and tomorrow you become a very large company, maybe a unicorn. Then you see how much of value you've given on the table. So that's also one of the ways you can really look at that. So maybe Kaustav, just wanted to come back to you, right? Now we kind of decoded the cost of capital and overlaid different options available, right? You want to talk about a journey of a typical SaaS company. What is an ideal I know you can't really generalize this, but maybe with certain assumptions. When are some of these options we just discussed become relevant at that stage? Just want, and I know that you also said even bootstrap companies can raise like alternative financing, but then maybe you can just look at a typical venture funded company who are most likely the audience that will be tuning into this. Yeah.
Yeah, sure. So for a venture funded company, somebody who's looking for alternative capital, you have to look at where in the journey they are in terms of the ARR, and where is it that they want to put themselves in the next 12 to 18 months, right? So for example, let's take it in slabs, right? So the first slab would be you have started off, you're in the first 12 to 18 to 24 months, you are less than $500,000 in terms of your ARR. For somebody who is less than $500,000 in terms of ARR, alternative capital helps, but that is not something that is going to take you to the $1 to $2 million ARR. For the simple reason being, again, going back to what is a fraction. For a $500,000 ARR, you're getting a fraction of your ARR, which is maybe 100, 150, 200,000. That doesn't move the needle for you that much. So at that point in time, it's where we are right now. I advise for 8 companies. I always tell people that when you are starting off less than $300,000, $400,000, think about raising a small round, right? Whether it is HNI, whether it is friends and family. Don't go for a price round. If you get a price round, that's fine. It's a longer process, but don't go for a price round. At that point in time, a smaller round helps, whether it is $500,000, million, million and a half, whatever that is, helps you. Now, when you start getting into the $1 million plus ARR, like let's take between $1 to $3 million of ARR, now your alternative capital becomes real, right? The funding that you're getting for, let's say, $2 million, you can get 600, 700,000, between $500 to $750,000 of funding that is it. That becomes meaningful for you. That becomes something that moves your needle without giving up. So when you are between that $1 to $3 million, until and unless you're at that stage, you're ready to become $10 million, you're ready to raise that $5 to $7 million, whatever seed you call it. That is when I encourage people to think about alternative capital to help you get that one extra customer, to help you go to that one
Right.
market, right? To get to that stage where you can go to a VC and say that, you know what, why I believe I should get this valuation, why I believe I should get that $5 or $10 million. We are what we call the last mile. We help you get to that last mile till you become a rocket ship and you go to a VC, right? That's a first place where we come in. Now, the second place where we come in would be you are a $3 to $7 million of, you've already raised $5, $6 million. Now you want to go to that $10, $20 million. Now, when you are a $5 to $8 million company, we can give you funding of $1 million to $2 million. Again, it is fairly significant for a $5 million company getting $1 million or $2 million of revenue-based financing. This is where you become a hockey stick growth. This is where you do something beyond. You get to a new product, right? Not just a GTM. Now you go to a new product that you're building. You build an entire marketing team. You build an entire sales organization that is there for that $2 million to give that ROI. And you go from a $5, $8 million to a $10, $12, $15 million. That's the second stage that you can use it. So typically in a VC funded company, that's where we have seen our sweet spot for alternative capital has been somewhere where you are $750 to a $3 million ARR that helps you go to the next level. Or if you are $3 to $8 million that really catapults you to the next level is where we have seen the usage of it.
So I
So
think
this is wonderful. Yeah, yeah, good, good, Lakshman.
to add to what Kaustav was saying, right? If you follow the typical journey of a startup, also of the fundraise and the equity dilution, which happens, that equity dilution typically happens at a seed round of around 15 to 20%, then Series A of 20 to 25%, and then Series B of 15%, and then it starts becoming a 10% thing. Where Kaustav mentioned that when you are around, you typically raise the seed rounds around that when you are in the 1 million fundraise sort of a thing, and then you raise a Series A when you are at that 3 million or a 5 million sort of a revenue base. If you can delay that, or if you can extend that further in both the stages, then even the dilution, which is a peak at that early stage, which is seed and the Series A, if you can delay that or reduce that dilution, that impact will be much higher at the
Longer.
later, where founders will retain a much significant stake rather than eventually of a 15 to 20% stake. If you have saved 10, 15, then becomes a 40% at the eventual stage. It becomes a 20% if you have not taken care, and if you could have extended it with this alternative capital at the early stages. But you need to be planning it very clearly, and you need to run this business very prudently for that.
No, very well said. Um, uh, Great. I think you're also bringing some practical angle, Lakshman, running your own company in that sense. And I wanted to come to that. And I think this is all about basically we're talking capital efficiency here. And I think my TIL moment here really was this whole fraction of the revenue and multiple of the revenue cost. So that's a very good framework to really assess what you really want to raise. And I think Lakshman and I keep talking about running these 100K, 200K experiments. So now we know, Lakshman, where we can go
Like
to
that.
as we run these growth experiments at Capita. Now, coming to, I'm switching the gear a little, and also Lakshman, given that you run Capita, and and talent is actually we talked about financial capital, human capital also is perhaps the most of the financial capital is actually going to hire the human capital. That's where I think most business plans are these days, because we're all living in knowledge economy, and it's more the people that determine, I think, success of these organizations. So maybe you want to talk a little about how to really efficiently scale businesses, keeping the talent in perspective, and what are some long-term incentive strategies. And this is where I think there's a plug into ESOPs, right? So we want to talk a little about the human capital angle and how can companies scale efficiently from using some of these instruments.
One of the critical things what we are trying to say here is about raising the alternate capital so that you protect your equity and not dilute the equity. And the second component is that how do you save the cost itself, cost component. And like most of the SaaS companies or all the knowledge based companies, the primary cost is the cost of manpower. Even for Capita, for us, the 70%, 80% of the cost is the manpower cost or people cost. And again, most of it would be, quite a bit would be the technology team in place, and then comes the GTM cost. The one way to save the cost for a SaaS company, and particularly in this funding winter stage, is if you can, instead of paying in cash, can give the some component of the remuneration in terms of the equity. One of the reasons why the people join startups is for the experience of that high growth, but also to move from one orbit of wealth to the next orbit of wealth. And cash never gives that, moves you to the next orbit of wealth, despite whatever be the component of cash you get. Only people move from only equity moves you from the one orbit of wealth to the next. And is for employee in a company, for employees, it is through the ESOPs. And if you can remunerate the employees through ESOPs and keep providing regular ESOPs in regular cycles, and also apart from providing the ESOPs, you also provide regular liquidity so that employees also feel that it's real, but it's not just a paper, then it is a very effective way of compensating the employees and also reducing the cost to the company. So what we are seeing now is that particularly ESOPs is very common in the US and in the Silicon Valley and in the US, because there is a lot of use cases and stories of where people have seen wealth growing because of the ESOPs. But in this part of the world, in India and Southeast Asia, the stories have just start coming up, like a Flipkart or something, like a 600 million payout to the employees. As more people see that the thing that employees, two people who joined two different companies, one with ESOP and one without ESOP, as one remained in at one stage, but other person has moved to the next stage, just because the difference was that one single component of the wealth came through the ESOPs. it's both benefit to the company and also to the employees in terms of.
Yes, and of course it's cash efficient because you're not putting cash on the table right away, and it's a kind of a you get paid out on the success of the organization itself, so it kind of aligns objectives very well. So I think great, Lakshman. So I think
I
before
just
we
want to
bring
add, and I just want
yes,
to add to what Lakshman said. I think this is super interesting, and you're 100% right in terms of the difference of the other thing which I like as a founder is ESOP for employees is it's skin in the game, right? So like what
exactly,
I have, so does my employees, right? So if it's a failure for me, it's a failure for you. If it's a success for you, it's a success for me. The skin in the game component is also extremely important when it comes to ESOPs. We are in it together, feeding off it together. It's
right,
not just you're a salaried employee that are coming in from 9 to 5. You are coming in to become successful together as an organization.
right. No, that's wonderfully put, Kaustav. Again, coming from a practical standpoint. Before we get into the next discussion on cross-border, I think there's a question by Anil, and so he asks. I mean, this is the same question about the working capital versus versus the other loan, right? So, in my experience, a working capital loan exposure is a perpetual obligation which just gets revolved over short tenors, while an installment loan gets paid down eventually. So, I think a specific use case. Anyone wants to react, comment on this? Maybe Costa.
Yeah. So a
Any
working
thoughts on
capital.
this? Yeah.
Yeah. So a working capital loan to an installment loan is a usage of it, right? So a lot of people, whoever asks a question, Anil, you're 100% right. A working capital loan can be perpetual if you want it to be perpetual. So why is that? The reason is I gave an example that if somebody is putting you on a net 90, which means that what does net 90 mean? I'll just spend 60 seconds to explain it. Net 90 means once you raise the invoice and it goes to the procurement department, you get paid 90 days from there. So what that means, you have delivered whatever needs to be done, but your payment is going to come 90 days later, right? Now, a lot of the firms that are there are strapped for cash, strapped for liquidity. What you want to do is you want to get paid immediately. So people like working capital providers will come in and say that, hey, instead of you getting paid from your supplier 90 days, I will pay you right now for a small percentage and small fees, right? Now, most of the people, whoever asked it is, I would say 100% correct. Most of the people always use working capital as a perpetual thing. What that means is as you are delivering, you would want to do it and get paid immediately. The example that I gave during the conversation was a very specific conversation in which you are in net 30, which means that maybe you're using working capital or maybe you're not. But for some reason, the procurement department has said that from net 30, I will put you to net 90. What that means is there's a very periodic one-time gap of that 60 days, and then you continue to be net 90 forever, right? So I was giving a specific example in which you are changing your net 30 to a net 90. But if you're perpetually net 90, you're right. A working capital is something that is, you would want the capital to be there and you continuously get it so that you get the capital 90 days in advance.
Got it. And I think Brian also responded to Anil. So RBFs or maybe the alternative sources, Costa, they are more like a fixed tenor
That is correct.
credit that you give. Yeah,
That is correct.
I think that's what Brian. So great. I think great to have a conversation in the chat room as well, and that's the objective of this. And I think Anil also asked another question on the free cash flow profile of companies that are eligible for these RBF or similar forms. Is free cash flow even a criteria cost of here, or how do you look at it?
When it comes to RBF, we do not have one fixed criteria, right? So we do not look at free cash flow in itself. We do not look at margins in itself. If we were looking at margins by itself, then we would have declined all of these growing companies, because the first 3, 4, 5 years they either do not have free cash flow or they do not have a margin positive. No one thing is important in when we are evaluating revenue-based financing. There are a bunch of things that goes in there. Free cash flow is one of them. Margins is one of them. VC funded, whether you are there, it's one of them. Whether you're a growing company or a stable company or a declining company is one of them. So there are multiple. Do you have any other debt that is in there? How you're servicing the debt for those things? It's when you're cooking, like India, a lot of spices go in that cooking. So it's very similar to that. Like when we are doing the risk evaluation, lot of things go in it. No one thing can be used for declining you.
Got it. So I think that answers Anil's question as well. So I think moving on, I think Kaustav, I wanted to kind of switch gear into the cross-border nature of companies, right? I think both markets are going global and sources of capital are going global. So the geographical lines are kind of getting blurred in that sense, right? So how do you think founders building these cross-border businesses, they're looking to grow, of course, across geographies, across their business teams are somewhere else, their engineering is somewhere else. So what are their unique challenges that you see, and how some of these instruments that we just discussed would be relevant for them? Again, you can take some example as well.
Yeah, sure. So cross-border, so the cross-border thing is, people also, this is getting a little bit into the technicality of it, right? So technicality of it is where you are headquartered matters, right? Are you headquartered in US? Are you headquartered in India? At the end of the day, if you're headquartered in India, like we know that getting capital from outside becomes slightly tad bit challenging in terms of what exactly is the type of capital there is. Is it a revenue or is it a debt? A lot of those questions are answered, and we are planning to have webinars on our own platform to educate people on that. But the easiest thing to look at it would be, when you are growing, is where you need the capital, right? For example, and I'm keeping it, doesn't matter whether you are headquartered in India or whether headquartered in US, where do you need the capital, right? So what we are offering as an example, it's an example, doesn't mean that fits it. What we are saying is, if you are India headquartered, US headquartered, doesn't matter, we are immediately able to fund you for a first product in the US. Use whatever you want with that funding in your US, whether it is a GTM, whether it's funding the people that are there, and the remainder of it, you can transfer it back to India. And even after you transfer it back to India, assuming you can, you're still better off in terms of pricing that are there, right? Because the cost of capital in India is still a lot more expensive than getting that capital in the US. That is our USP, right? That is what we are trying to educate the founders, is anything that is regulatory viable, if you're able to get the funding in a country that is cheaper and you're able to bring it to your home country or where your cost base is, at the end of the day, it becomes a lot more cost effective and capital efficient for you. So the important thing would be where you need the capital. And the second thing is the cost of capital as you're becoming global.
I think
Wonderful. I think, well, yeah.
If you are able to solve that thing of raising in a low cost place, and then if you can following all the regulatory requirements and bring the capital into India, I think you will be solving a massive problem. Because in India, right from the beginning, the regulation is that only from overseas you can put equity, but never debt, unless it is a very heavy enterprise and much regulated scope. But if you can bring that benefit of raising debt in US and bring it to India and spend in India, then I think you are solving a very critical problem.
That's exactly correct. And that's the reason it's important to understand where you are headquartered.
Yes.
No, that's definitely the chartered accountant Lakshman speaking, and also doubles up as Qapita CFO at times.
Earlier, before being here, I was investor in and put a lot of money from overseas into India. A lot of times we tried, even as a large enterprise, to put as debt into India is extremely difficult. Only thing you can put money in India is equity or a convertible equity, but never straight debt sort of thing.
Even equity is very difficult, Lakshman, and you would know it. I know I'm preaching to the choir, but even equity directly from US is not as easy to put in, even if you are in India, like FDI regulations and so on are there to be able to do that.
And we in fact did a live on that already with Inventus and 𝐒𝐚𝐻 a few months back, actually, after those regulations that came last year. So great. Lakshman, I wanted to again bring back the human capital angle here with similar question on the cross border, right, with multiple jurisdictions, etc. So anything you want to add on that? How can founders navigate that journey from attracting talent, retaining talent across these?
Right, particularly when as SaaS companies, right, particularly companies which are setting up as not even whether building from India for the global or incorporating in US and outsourcing the operations to the low cost base or outsourcing the technical testing. Now, earlier only large companies used to have operations in multi jurisdiction. It used to be after 10 years or a 15 or a 20 years into your journey. But now even startups, even by second or third year, you have headquarters in USA, then you have technical bases both in India and in Europe, and then you have BPO and call centers in Philippines, and multiple bases. So people are taking the best resources available in the different parts of the world. uh, I think the one thing which comes in as human capital is that how do you recruit the team? And if you have to recruit the team, then generally, then earlier the only way people have to do this, then you have to incorporate subsidiaries in each of these countries, and then incur cost in incorporating the companies, and then incurring administrative cost to manpower. But I think in some one instance, quite a bit of innovative startups have come and solved that problem of.
Right.
Where you can pay a fees, and then they take care of recruiting the means keeping the headcount on their respective books, and you pay the fees for them. That solved a very massive problem, and I'm coming with 15-20 years of experience of trying to do this before, and how now we are able to do it, and how we were trying to do it even 5 to 10 years back. This is a massive problem solved of to immediately expand and recruit people and follow the local regulations. And the second is that then how do you compensate the teams there? And again, as we said, in startups, you component everywhere it comes is both cash and equity. Cash is a little bit straightforward, but then you need to engage the respective advisors or the accountants there. But then equity, again, you need to follow some regulations which are specific to the jurisdictions. Then that's where it now companies like us or others are coming and helping to provide the relevant guidelines and build the policies which meet the local regulation. But the main thing is the software aspect, I think, where to maintain the culture of the company, because culture is built over the years. Where in earlier, once you build a company, then you set up a branch, then you set up that, then one by one you slowly expand. But now you are expanding simultaneously into 5 to 10 countries. Along with the speed, you need to keep that culture of the company. Otherwise, the different parts of the different branches are working in different directions. Need to communicate regularly and keep the engagement to keep that culture going.
Great. And in fact, we did a live with a company that actually offers us glow roots last week. So that's also relevant. And there are many other companies as well, but to the point you just mentioned. So maybe we're coming towards the end of this conversation. There was one more question actually by Sagar. And this is a very generic and broad question. Like, what are some practical tips for implementing a lean operational structure in a SaaS business? Given that you run your own companies, any comments on this, Kaustav, Lakshman?
I mean, for me, at the end of the day, like there's no right or wrong. We are also building our own company. The definition of lean is very subjective.
Right.
I'm an 18, 19-month-old company. The most important thing that me and my co-founder Manish, what we try to keep in mind is like what is absolutely necessary, like which is like a good to have and a must have, right? We are at a stage in which everything that we have should be a must have, right? Until and unless somebody is really pushing themselves and working XYZ hours, or we are really stretching ourselves, we look at every dollar that is spent and we debate every dollar that is spent. And it is very important that where you are spending the dollar that is there. And the other thing about, and we are not a typical SaaS company, we're a financing company. The other thing that we keep in mind is the allocation of capital when it comes to infrastructure and allocation of capital when it comes to people. So for us, infrastructure is a big cost of allocation that is there. And we try to make sure that while we are lean, we're also using the most relevant stack that is there. We are using the most up-to-date stack is there. And that is the place where I don't mind over-investing, right? I'm just giving an example where I don't mind over-investing and where I question 15 times before saying that if I have to hire somebody, I question 15 times, right? If I have to spend 10% more because I'm investing in a stack which I very strongly believe is going to give me an edge over my competitor, or it's going to help me be one step ahead 12 months from now, I don't mind that over-investing. So that is where in my organization, working with Manish, I try to manage these two things simultaneously.
Very well put. I think, yeah, Lakshman, go ahead. Yeah.
Only a couple of things to add to what Kaustav said. As by definition, startup means a lean company. Then if you are not lean,
Right.
startup anymore. And particularly in a SaaS business, I think there were only couple of two costs only, right? One is the manpower, which is the technical cost, and then second is the GTM cost. I don't think the technical cost, it's all about having the best, the good quality engineers and working together and having lean teams will get the velocity. Measuring the velocity of the tech team is the most critical thing. And then second, on the GTM basis, is established metrics are there in the SaaS of the, depending on what ARPU level you are, whether it's you are a $100 ARPU, 1,000 or a 10,000 or a 100,000, each of their established metrics of CAC to LTV ratios, which people have established this. As long as you keep that metrics following, and they're established that when you need to, how you progress and bring that into the global standards, as long as you're following the metrics of that, then one is good.
Great. Thanks, both of you, for the perspectives. I think the last question I had for Kaustav was actually, I mean, this is something I just thought of when you were answering the earlier question. Given that, I think with the kind of funding or financing cost you bring in is kind of, interspersed between other, equity rounds. So how do you see typical VC's response towards an alternative financing like yours, right? Is it a pro or a con, and also who's already on the cap table versus who's coming later on, right? So what are your thoughts and observations from
Very interesting
companies?
question, and I can plot it by the timeline. So if I was asked this question in 2021, I would have said that VCs would have said that, why do you need this alternative capital, right? And you would have said that, okay, fine, this is some sort of competition with the VC. Right now, we are VC friends, right? Because VCs wants their portfolio companies to extend their runway. VCs wants their portfolio companies to stay in to get the valuation high up. So we actually partner with several VC firms, a lot more than what we were 6, 10, 12 months back, in which they actively push it down to their portfolio companies, right? So it is something that has dramatically changed in the past 18 to 24 months as the availability of capital from the VC world has become difficult. And the second thing is, again, there are two different types of VCs that are there, but all VCs are progressive enough to not to look at this as a long-term debt. So when you said that there are two types of VCs, one which is already in the cap table and the one which might potentially come in the cap table. People who are in the cap table, 100% they're fine. People who are coming in the cap table, they don't look at this as a long-term liability, right? They look at this as a short-term current liability, and they look at it's going to churn out in the 10 to 12 months. So in regards, it is never a negative for any of the VCs that we have seen, whether they are already in the cap table or whether they're considering to come into the cap table.
Very nice. Very well put, Kaustav. And again, I think your mental model of as long as it is fraction, I think they'll be very happy. If it is multiple, this is where they'll be worried about. So great. No, I think this was a fascinating discussion. I think we can have a quick round of closing comments as well, but I'll see if we can squeeze any more questions as well. So if anyone is listening in and you have any more questions left, we have a wonderful set of speakers here, so do take this opportunity. But maybe over to you both. Like my last question was more about, again, elucidating more case studies of how, what are typical tips to founders listening into this as growing their businesses. So maybe each one of you can weigh in from your perspectives, and then we can close. Yeah. So maybe Kaustav, you can go first.
Yeah, sure. So, I mean, I started that point, and for all of the founders, SaaS founders, non-SaaS founders, 1 year, 3 year, 5 year, there is a typical thing that I said, that debt or financing is your friend, right? Especially where we are right now. And it does not mean it's efficient capital or revenue-based financing. Any sort of alternative financing is your friend, right? Don't shut the doors. Don't get out of that feeling that it's a stigma. There are many positives. This is what is going to help you grow. As Lakshman put it, the 5% of dilution that you are saving for your seed round or your Series A is actually a multiple that you are saving when you become a multi-million-dollar, maybe even $1 billion company, right? So this is the time for you to consider alternative capital. This is the time for you to be smart and save on that dilution.
I think just to add to what Kaustav said, means both instruments are correct and both of them are right at a particular point of a time. And equity has its own importance to raise at the right point of time, because you need to scale at the right point of time. And equity, as Kaustav mentioned, is a multiple, and it gives you that fuel to grow. And particularly when the market conditions and the competitive landscapes changing, or you want to expand, it gives you that fuel. But also raising disproportionate equity will hurt you in the longer run, and it also would provide disincentives between the founders and the shareholders, because the founders will get heavily diluted and there's no incentive for them to perform. And then keeping the debt in mind of the various forms of debt. Again, all forms of debt are good, and also at the right amount of time, whether venture debt, supply financing, or what Efficient Capital Labs is providing, all need to be explored at the right level of businesses, for the right scale of businesses, and use it effectively so that you can extend your cash runway, both for working capital or for your any other acquisition or M&A opportunities, and then scale properly. But one thing is that be close to profitability as much as possible, so that you are ready for any market downturns.
Yes, I think that's a golden rule. I guess every startup founder is now gravitating towards. So wonderful, gentlemen. I think this was a very fascinating discussion. A bunch of questions as well. So it was quite engaging. So thanks everyone for tuning in. And Kaustav, thanks for being a partner to Qapita as well. And we'll of course have more of these conversations on similar relevant topics. And Lakshman, as always, thanks for being part of this conversation. So I hope at the end of this we are very clear on all the choices of capital. What are the efficient sources in that sense? But what are the relevant choices founders can make at the relevant points in time? I think it was a very practical and practically oriented discussion. So I hope our founders have a lot to take away. So thanks again, both of you, for joining in, and we hope everyone has a good day and a good year to come as they build their capital efficient businesses.
Thank you so much for having us.
Thank
Thanks
you.
again.
Thank you. Thank you, everyone. Bye.